We knew we were in a really weird place in the market when we said that our pick, Nvidia, our baseline assumption was that the company would only grow 40 to 50%.
The baseline assumption for the stock was 40 to 50% growth.
And everyone thought that was super boring.
That was a really dumb idea.
That's the kind of market we're in right now. Stocks are up 1,000%. It's crazy.
But now that that's happened, all in the span of just April and half of May, let's go back to the boring, most obvious AI infrastructure and ruler of the world, if we can be so bold as to say that,
Ruler
NVIDIA,
of the technological world.
and therefore the world, NVIDIA. Hey, let's talk about the 5-layer cake assumptions here really quick. Very much in force right now. We are all out building the bottom layers, especially the bottom 3 layers. That's where all the investment is flowing in 2025, 2026, and probably also in 2027. Money is being made right here, except if you happen to own NVIDIA stock. Kind of a sluggish 15 to 20% increase so far year to date, which in a normal year would be absolutely fantastic. But this might be about to change though. We talked about the CPU shortage just a few weeks ago. And at the end, if you caught that, if you watched all the way to the end, said, who might be the value play here? It might be NVIDIA. Let's run down what they said in Q1 fiscal year 2027.
Here is the new revenue segment breakdown for NVIDIA. They're transitioning to a new reporting framework. You can find this in their Q1 2027 reporting materials. They've updated these numbers to reflect the last 9 quarters in this new reporting framework. They have 2 market platforms, data center and edge computing. Within data center, there are 2 sub-markets, Hyperscale and ACIE. ACIE is going to incorporate AI clouds, industrial, and enterprise, while Hyperscale is going to include revenue from public clouds and the world's largest consumer internet companies.
Basically, Amazon, Microsoft, Alphabet, Google, and Oracle, Meta, those 5.
And then ACIE, that is going to be all those AI purpose-built data centers, AI factories across all types of industries and countries, including sovereign data centers, the neoclouds. And then the next reporting segment is edge computing. And that's going to be all of the processing devices for agentic and physical AI. And that includes your PCs, gaming consoles, workstations, their AI RAN base stations, robotics, and automotive. All of that's going to be lumped into edge computing.
Which NVIDIA has been telling us for a while now is eventually going to be the next massive growth driver for the business. Now, naturally, there were some questions about this reshuffling of the revenue breakdown during the earnings call. It makes sense that analysts would be a little bit interested in the rationale behind this, but we actually don't think this is all that big of a move. And in fact, I think we've been talking about this happening, or at the very least explaining what is actually happening behind the old revenue reporting segment for quite some time. And so we like this change because it sheds a little bit more light into NVIDIA's business. Yes, the hyperscaler customers make up an outsized portion of total overall revenue. That's the hyperscale sub-line item under data center. But there's a long list of smaller enterprise customers and emerging really big customers within the second sub-line item, AI clouds, industrial, and enterprise. And where exactly is that coming from? We've been showing this on our semiconductor end market cycle trend chart for a couple of years now. Cloud and enterprise is a really massive catch-all for us. That's how we classify this really big catch-all, as is auto, industrial, and power there at the bottom. And what is that? Cloud and enterprise? Well, it encompasses legacy data centers, legacy compute. And if we can borrow this slide just one last time from Gartner, what is that exactly? Well, the majority of global IT spending is actually not the cloud. It's not hyperscalers, most of which they have categorized as data center systems there in their top line item. Still to this day, 80% of global IT spend is legacy systems. It could be legacy internet service providers, mobile networks, IT service companies, software that still runs off of really old license-based purchases. And maybe the cloud was interesting Some of these companies have made small amounts of use of the cloud to some extent over the last decade and a half. But AI is the real killer use case now, the killer app that is getting people to really migrate en masse to modern IT infrastructure.
AI is not a want to have situation. It's an absolute necessity of our daily lives at this point.
Yeah.
Very quickly, this happened.
And this is why Jensen said in the last earnings call that their revenue should actually continue to grow faster than hyperscaler CapEx. And I think the segmentation of that data center segment into two portions now, basically hyperscalers and everybody else, is going to give more insight into that massive migration that is just now beginning to take shape in IT enterprise beyond just the hyperscalers.
I think it gives us a really good picture and helps us with analyzing hyperscaler CapEx spending and comparing that against all of the others.
Yeah. And now we don't have to try to explain it anymore. NVIDIA,
They're doing it.
thanks for watching our videos and taking some cues from how to break this down for everybody. You obviously have a much wider reach than we do.
Hey, but if anybody from NVIDIA wants to come on, come, including
Jensen, we've been following you since before anyone cared. When the financial community especially didn't know a thing about Mellanox, let alone that they should care about the acquisition of a company like Mellanox, we were there. Come on the show. You're going to get an interesting place to talk about some things. We're not going to ask you the same dumb questions that everybody wants to ask you. It'll be a unique experience, and let's do it. Let's make it happen.
I'll pull out my leather jacket.
Jensen, if you come on the show, I'll get a leather jacket. That's probably not a compelling reason to come on, but
We'll try. Okay, let's talk about free cash flow because we love talking about free cash flow. This is a look from one of our charting capabilities over on chipstockinvestor.com. Make sure you check it out. Semi insiders get access to this and a lot of other research tools that we're building out over there. chipstockinvestor.com.
check it out.
Okay, $49 billion in free cash flow Q1 fiscal 2027, which is nearly a 60% free cash flow profit margin. Revenue is headed to well over $300 billion this year, so that number, that free cash flow is going to continue to climb.
Maybe 400 billion or higher this year in revenue is almost the implication with the guidance.
Right, around 91 billion for just next quarter alone.
Yeah, and then beyond that, now we're hitting Vera Rubin, including the Vera specific CPU-based systems, which are going to hit 20 billion in sales basically in just 6 months' time. We're probably going to have well over 100 billion in revenue, we think, in Q3, Q4 for NVIDIA.
One thing that we will be discussing with our semi-insiders is NVIDIA's claim that they're going to become the largest CPU supplier this year. It's very interesting.
I think we already called this out during the big CPU update we did. That probably was more than just a remote possibility. If NVIDIA says it's going to happen publicly, they must have a high degree of confidence that actually is going to be the case. So possibly, as crazy as it sounds, we have another increase, another reacceleration of revenue during the second half of fiscal 2027.
So how's NVIDIA looking? Currently, stock price for NVIDIA is about $223. That's at the time of this recording. And as Nick mentioned, it's been relatively sluggish in comparison to a lot of the other bottleneck and layer providers across the semiconductor industry. What type of growth is baked into the current stock price, and is it feasible that NVIDIA is actually very reasonably priced?
Yep, we're going to use free cash flow per share in this scenario using our simple DCF and reverse DCF calculator. The scenario we ran to get it to fair value based on the stock price as of this recording is an average of 20% free cash flow per share growth over the next 5 years and a terminal rate of 6% thereafter. Obviously, that growth rate would be less if you used GAAP earnings per share instead, because GAAP earnings per share are a bit higher, but we wanted to use free cash flow per share, even though it's a lumpier metric. Not exactly a low bar to clear, but obviously the lowest bar NVIDIA has had for a while. So I think baked into the scenario is still this assumption that within the next 2 to 3 years, there's a cycle slowdown, if not a temporary cyclical decline for the semiconductor market. So that's where we're at, and our viewpoint on the company being worthy of just holding as our personal largest position Doesn't mean that should be the case for you at all, but for us anyways, I think that assumption needs to remain unchanged. We are going to update our baseline assumption though after the Q1 report, because it and the outlook for Q2 and the rest of the year was obviously necessitated a big revision to the upside.
Yeah, so here's some assumptions for this year, calendar 2026. GAAP earnings per share and free cash flow per share growth were up 214% and 88% respectively in Q1 fiscal year 2027, which just ended in April of this year. Stock price is up about 18% since the start of 2026. And so if Nvidia per share profitability increases by another 80% plus this year, we think a slower growth rate for the stock itself, maybe 50%, would be healthy to allow for some future slowdown or cycle down.
And that's a big revision. Before, at the midpoint, we had set maybe something in the ballpark of 40%. I think there's room for Nvidia, obviously, to continue to run higher because a lot of interest has crowded into small cap and micro cap land. Bottleneck and choke point is the jargon of the day that the financial markets and traders and so on are latching onto. And so a lot of interest has been sucked out of Nvidia, even though they are the ones that actually wield control over that entire supply chain. It's, I guess, kind of a boring business at this point, but
it sounds funny to say that about Nvidia.
It does sound funny to say that, but we've been talking about boring stocks as of late, and some of these so-called boring stocks that we've been told, why are you bothering covering these, are up several 100% in just a couple of years. If you're not happy with that, God help you.
Find a different channel. Thanks everybody for watching this episode today. Make sure you check out chipstockinvestor.com and Semi Insider, where you get all of our research and a platform of tools that we're building out for investors to cut through the noise and actually make good decisions. See you over there, and we'll see you soon here at Chipstock Investor.
Should we tone down the end of
Yeah,
their, like,
yeah, just
God help you?
Yeah, just cut all that out. Just end it where it doesn't sound like we're being a couple jerks.
Maybe we should just be a couple of jerks. The Vibe Your Sass guy would say, like, it needs to be bold. So just leave it.